Hey everyone, Sebastian here. Let's talk about an easy way you can save money monthly by refinancing your home mortgage. Stick around to the end of the video where I go into the details on how I saved $1,324 a month on my mortgage payment. If you don't currently have a mortgage, stick around. I think you'll learn something that might be useful later on in life. But before we dive into the details, it would mean a lot to me if you would smash the like button and subscribe to my channel. I really do appreciate it. Thank you so much. Okay, so unless you've been living under a rock, you may already know that interest rates have been falling for the past couple of years. By refinancing, you can save each month by lowering your interest rate, getting rid of the PMI, private mortgage insurance, and possibly removing the escrow account. However, if you plan on moving in the next couple of years, refinancing may not be the best solution. And here's why. When you refinance at closing, you have to pay the closing costs, which can average anywhere between a couple $100 to a couple $1,000. And based on your savings from the refinance, it could take on average 3 to 5 years to break even. There are plenty of mortgage refi calculators online which can help you determine if refinancing makes sense for you or not. I'll leave a link to a couple of them down in the description below. Currently, the 30-year fixed mortgage rate for people with FICO scores above 760 is about 2.48%. And for people with FICO scores below 639, the APR is around 3.97%. Typically speaking, if you can lower your interest rate at least a half a percentage point or more, then it makes sense to refinance. For example, if you lowered your interest rate only by a half a percentage point, say from 3.5 to 3%, you would be saving around $26 for every $100,000 financed. So on a $100,000 mortgage, you would be saving $312 a year. If your closing costs are $1,500, it will take you approximately 5 years to recoup the initial closing costs. Let's stick with the same $100,000 mortgage, but this time you reduce your interest rate by a full percentage point, from 4 to 3%. So now you are saving $56 a month or $672 annually, and the same closing cost of $1,500 now only take you 2.25 years to recoup instead of the 5 years with only a half a percentage point drop. You can quickly see that the higher the interest rate drop, the faster you can recoup the savings from the closing costs. In some cases, you can also roll in the closing costs into the actual loan, but this is typically when you have a loan amount that is lower than 80% of the home value. But for some, this is a great way to refinance without having to pay the closing costs up front. So let's recap. Half a percentage drop lowers your monthly payment by $26 a month for every $100,000 financed. A full 1% drop equates to around $52 in savings a month, meaning on a $500,000 mortgage, if you lowered it by 1% interest rate, you would be saving around $260 each month. That's substantial, that's a lot. Okay, so that covers the potential savings from lowering the interest rate. Now let's discuss the 3-letter dirty word in home mortgages. PMI, private mortgage insurance. In 2016, about 25% of all home loans were required to get PMI. PMI is there to protect the lender in case you or I default on our mortgages. So when is a PMI required? In general, when you purchase a home and put less than 20% down. For example, if you were to purchase a $200,000 home and you only put down 5%, which is typically the minimum required, you're basically putting down only $10,000 on that home, and you're borrowing $190,000. Because of that, the lender will require you to get a PMI, but if you put down $40,000, which is equivalent to 20% down, now your loan amount would be 80% of the home value. And the lender would not require for the PMI to be included. Okay, but how do you go about getting PMI in your current mortgage? There are 3 ways you can reach 20% equity in your home in order to get rid of the PMI. The first way is for time to do its work by itself. Home values typically rise on average 2.2% annually in a good market. Given enough time, your home's value will increase by itself. The second way is by paying down your mortgage. Each month you write a check for the mortgage payment. A percentage of that payment goes towards the principal and the interest. And in the beginning, unfortunately, the majority of the payment goes towards interest. Adding just $50 to $100 each month towards principal on your mortgage payment can reduce the loan amount and accelerate the increase of equity in your home significantly. For example, if you bought a home for $200,000 and you put down a down payment of 5%, which is $10,000, and you got the loan for the balance of $190,000 with a 30-year fixed mortgage rate of 3.65%. In 5 years, you would pay down that mortgage by about $20,000. The remaining balance on your mortgage would now be about $170,000. During those same 5 years, your home value on average could grow by about $20,000, meaning your home is now worth $220,000. So now if we take that $220,000 value in your home minus the balance of $170,000 on your mortgage, we end up with $50,000 in equity. This would now mean that your home to loan value is about 77%, or that you have 23% of equity in your home. Congratulations! You basically are able to refinance and remove the PMI at this point. The third way is to add value to your home by remodeling or adding features to increase the value. An easy way to do this is to make your home more attractive. On the outside, do some landscaping around the house. Plant some flowers, trees, shrubs, whatever it takes, but make sure everything is well maintained. On the inside, a minor kitchen remodel recoups 81% of its cost and added value on average. Same with a minor bathroom remodel. You could also finish out the basement, build a deck or patio. Anything you do to increase the usable square footage of your home will end up driving the value up as well. Plus, the more you can do yourself, the more value you can add with a lot less money. And if you don't know how to do something, well, there's always YouTube for that. And if you like that tip, smash that like button. Now let's talk about how to get rid of the escrow account from your monthly mortgage payment. Escrow is required by lenders with the same stipulations as with PMI, meaning you need to fork out 20% for the down payment on your home. Otherwise, the lender will require you to have an escrow account. Basically, the escrow account will hold the amount needed to pay your property taxes, your homeowner's insurance, and possibly your homeowners association dues. The amount of escrow payment needed each month is calculated by taking the total for property taxes, insurance, and association and dividing it by 12 months. Some lenders also require a surplus on hand and typically equates to about 2 months worth of escrow payments. I've always preferred to pay my property taxes and home insurance separately. For example, I can pay the property tax and insurance with one of my credit cards, where I either get cash back or points for miles. If you're going to do that, just make sure that you pay down the credit card at the end of the month. With the money you save from not having the escrow account, you could put that money in a high-yield savings account, a CD, or invest in the stock market. But if you invest the money in the stock market, make sure that you at least have 20% or more, just in case if the market drops and you need to make a payment on your property tax or insurance. And that's why I refinanced my mortgage this past September. I had to wait for the home value to increase, my loan amount to decrease, and the rates to drop, in order for it all to make sense to me. I also initially tried working with my local bank, where I had my checking and savings account. But unfortunately, they couldn't match the rates that were being offered by other institutions. So I ended up going with a mortgage broker instead. But that's for a totally different story all on its own. All in all, I was able to save a large amount on my monthly mortgage payments. I got rid of the PMI and eliminated my escrow account. The reduction in PMI saved me around $102 a month. Lowering the interest rate from 3.65 to 2.9% saved me another $122 a month, for a grand total of $224 savings each month. But that's not all. With the escrow account gone, I ended up saving another $1,100 a month. So that's around $1,324 a month, or $15,888 annually in savings. Yes, I know that I will have to pay the property taxes and the homeowner's insurance myself, but at least I can make my money work for me. I can invest it, I can pay down credit cards, or I can pay off student loans with high interest rates. That's it. I hope you found this video useful. Take advantage of refinancing if you can, and as always, it would mean a lot to me if you would subscribe to my channel and click that little thumbs up button. Thank you so much for watching, and until next time,